Hi, everyone. Delfino Aguilar here, your host of Del Talk. I am really excited to have our newest guest, Mr. John Shrewsberry. John, thank you for joining.
Thanks for having me. Glad to be here.
Yeah, and John, we were talking a little bit about baseball. Hopefully, we talk a little bit about baseball towards the end of the interview. But John, you've had an awesome career. Most recently, John, you served as the CFO for Wells Fargo Bank for many years, right? You just retired last month. Was it last month when you retired, John?
At the end of March, I retired. I was the CFO for 6.5 years and had been part of Wells Fargo since 2001, which for your audience is when the company that you and I used to work for got sold to Wells Fargo, and that's when I joined.
So John, so we worked together at like you said since 2001, right? In Carlsbad. Those were the great times when we were doing those commercial loans, right?
Those were good times. Working at the beach, wearing flip-flops to work, working with a bunch of fun, energized young people, startup environment. Those were good times.
Yeah, that's it. And we're kind of in a startup environment here at our company right now too, in a way, which we'll talk a little bit about that. But John, what was, you had such a great career at Wells, and you did a lot of mentorship and like you said, you worked with a lot of young people throughout your career there. What was one of the highlights that you had of your career at Wells? I'm sure you had many, but can you pick one out?
Sure. The highlights, there were several. And sometimes it was when I would get asked to do something new and entirely different compared to what I had done previously, and I had to,
Right.
step outside my comfort zone and manage a new part of the bank. The biggest highlight was probably in the middle of the financial crisis. For those of in your audience who are old enough to remember it, Wells Fargo basically doubled in size by buying a competitor of the same size because the bank had lots of capital and liquidity, and Wachovia, who was the target, wasn't really in a position to stand on their own. And so,
Yeah.
really, in the course of about a week, less due diligence time than you would take to make a home loan, we
Right.
agreed to bank $1 trillion bank, of which was roughly of equal size. So that
Wow.
process of doing the work, getting it done, and then obviously integrating the two companies together was something you can only do once in your career. That's the largest financial services merger ever, and nothing like that can ever happen again. So that was a big one.
Yeah. Yeah, that was a big one. I vividly remember that when that was happening. And that's a lot of collaboration with getting a lot of personalities together, a lot of different cultures too, right? Like the Wells culture, the Wachovia culture. That was a transition. Can you talk a little bit about that, the culture piece? Was it easy to blend the cultures?
It's a great question, and it's funny.
Yeah.
Wells Fargo had lots of different cultures before
Yeah.
that merger, depending on what part of the company you worked in, what part
Mhm.
of the country or the world you worked in, how
Yeah.
long you've been around. Because both Wells and Wachovia were products of multiple mergers that had come previously, and so everybody
Mhm.
arrived at this merger with their own perspective on where they came from.
Yeah.
And I found that in a place like Wachovia, which different than Wells Fargo, had big concentrations of people in a handful of cities. Wells Fargo was much more distributed. I could walk into a room or into a town with 25,000 employees, and people would say, "Gosh, we feel like we're out here on the frontier." And my observation was, like, everybody feels like they're on the frontier. Where
Right.
it was different in that they were used to being a headquarters driven sort of organization, and Wells Fargo didn't work that way. So it was an opportunity to create a whole new culture. And as
Yeah.
most of your audience knows, Wells Fargo discovered a few years later that there were breakdowns in parts of its culture that needed to be reinvented too.
Mhm.
And so that's, like, you're never done with that work, and you
Right.
always having to set examples and test and make sure that you're living up to the culture that you want.
Yeah, that's awesome. For us, John, at Kind, we chose Kind for a reason, the name. Glenn chose that name, him and Mindy, right? Thinking about bringing our industry, the mortgage industry, there's a lot of business for everyone out there for us. And it's about competing with kindness, right? And being able to build your brand that way and really mean it. John, thank you for sharing that. The culture piece is something we focus here a lot at Kind. Transition a little bit about the financial sector. So you guys went through, you were, part of the bank, leading the charge during the Corona epidemic, right? The pandemic, excuse me. How did you guys manage that, and how did the financial sectors in general deal with that? And what do you think your opinion is on that? Like, how did it manage? How did it change during the last 12 months?
A few things all happened at about the same time.
Yeah.
First of all, markets, stock market, credit markets were in for a free fall at the end of the first quarter of last year before the Fed stepped in and stabilized things. And we should all be glad that they did, because that really reduced the risk to the system and to people broadly by creating more confidence in markets. Obviously, the mortgage market was a huge beneficiary of that. Fed stepped in and began buying mortgage securities in huge size. So for a brief period of time at the end of the first quarter last year, the worst felt like it was happening, and then at least financial markets got stabilized. The real economy, from a bank's perspective, was impacted in a range of ways. Our bank is a consumer and a corporate and commercial bank, and so we were concerned about what's going to happen to our consumer customers. Jobs and incomes could be negatively impacted. So can people pay on their mortgages? Obviously, in the mortgage space, we put these long-term forbearance arrangements in place so people didn't have to pay if they couldn't, or even if they didn't want to, but they didn't have to, and it wasn't going to be held against them. And that was very helpful. Same thing happened. Something similar happened in autos and in credit cards that gave people breathing room if they were having an interruption in their income. On the corporate side, it's a little bit different. A lot of customers came in and asked for forbearance, but it wasn't necessarily payment forbearance. It was covenant type of forbearance, because their performance wasn't what they hoped it would be. They still had liquidity. They could make payments, but their sales were down, their rents were down, their other current income was down. And the amount of liquidity that the Fed injected into the system through all of this safety net that they had deployed was really helpful to both consumer and commercial customers in that instance. Also, from a bank's perspective, I think we grew our deposits by a couple $100 billion in the course of just several weeks or a couple of months as the stimulus programs began to roll in. And of course, if they weren't paying their bills, they began saving more cash in their accounts. So we had to think about credit, and we all put up big reserves in the first couple of quarters of last year, most of which, as we've seen banks more recently, is getting released back into income because losses didn't happen the way that they might have. Right. Again, thank the Fed for that.
Yeah.
The other thing we've had to figure out how to do is we have close to 300,000 people, and more than 200,000 have been working from home for a year. And I think Wells Fargo, incidentally, I say we, even though I'm retired, but I can't.
Yeah.
Fargo is planning on getting people back into the office at the end of the summer, but everything we do, besides things that happen in branches, maybe some trading floor activity, just about everything else has been done remotely. And nobody knew if that could actually happen. It certainly was part of the resiliency or disaster plans in the event that it was ever needed to be called on. I don't think anybody imagined everything would need to get called on at once. But it's worked like a charm. And so in the future of work probably looks a lot different for banks, as well as many other, types of industries, and maybe office work in particular, where you don't have to be where people thought that you had to be previously. So that's different.
Yeah. It did. That's a lot of people, 200,000 people. A lot of our, in our sector, people were working from home to begin with. Right. But we had to move everybody that was in our offices home, and we did transition that quickly, but 200,000 is remarkable. And what I'm starting to see, John, we were actually an event in Utah. So I'm flying around the country now. I'm in Florida in 2 weeks, and we met with like 30 of our mortgage broker customers and loan officers. And a lot of people are it's interesting. A lot of people want to still work from home, but a lot of people still like the people connection, right? Of being in an office. Like, when we worked together, that was the funnest times, when being in that office was built camaraderie and connection. So I think that we're still going to see people wanting to work from home, obviously, but people are excited. We were shaking hands and everything, and bro hugs and all that stuff. And it felt great, right? So it felt great being out in the field. So John, let's talk a little bit about the mortgage market. In March, we had a big increase in, home prices have gone up tremendously, right? Especially in March, with the biggest increase, one of the biggest increases in 15 years in home appreciation. I think it was like 15% or 10%, excuse me, since 2020, So where do you see that? I mean, there's a lot of talk. People are talking about another mortgage bubble. Where do you see that mortgage market? And is there pressure in your eyes on property values in general?
Yeah. Well, the mortgage business is a local business, or it's an MSA by MSA and property type kind of business. So bubbles can occur in some places and not in others. But these big spikes in values, I see them in the Bay Area for sure. Like they're real affordability problems. I think mortgage lending, and especially in the government oriented programs, mortgage lending buttoned up enough not to create the type of mortgage risk that existed in the financial crisis. But we're going to run out of homes for people to buy who can't afford to buy. There's homes in the Bay Area that are going for $1 million more than the asking price when they're offered for sale.
Wow, yeah,
ridiculous. And that's a very hard to finance corner of the market. That's more of a gap, I think, for people who are have their own reasons for wanting to do that. But the further prices run up, the more pressure there'll be to create new supply. So, that people have been working hard all over the country, I think, to introduce new supply, home supply, not
right. Right.
So that's got to be dealt with. But, incomes aren't increasing at the level that prices are. And so affordability is going to be an issue, and we're going to have to figure out how to deal with that.
Yeah, definitely. I see that. And then we had a jobs report that was kind of light today. That was reported kind of light. So I think we're going to start to, hopefully we see some improvement in that too. How do you see the job report being reported today affecting the markets at all? Or you think, the 10-year moved a little bit, it dropped to 1.4 initially. It's back at about 1.5 right now. Any thoughts about that?
I think people have to digest how it can be that so few new jobs were created when job openings and, hiring or jobs applicants wanted are as high as they are. There's lots of people who are hired, and not that many people who are putting themselves in a position to be hired. So some of that, I think, is still the residual of COVID. If people's kids aren't in school, then they're not going to work if they can't do it remotely. So it's jobs that you just can't fill. There are some people who've moved from one place to another, and their in-person job, the in-person jobs in the community that they left, or the neighborhood they left, aren't going to get filled. So the good news is that employers want to hire. I'm more worried about jobs issues when there are no jobs. We need a job. You have to figure out how to bridge getting people into them. And I think, vaccination is certainly a part of that. Open schools are a part of that. There's some discussion about whether or not the stimulus programs at the state and federal level are creating a disincentive to work because theoretically you get paid more, or as stay home is due to work. I'm not sure if that's a real problem or not, but once these programs run their course, then we'll figure that out. So
awesome. Yeah. John, we talked a little bit about the 10-year. It's at 1.55 around now here today. Any thoughts on where direction that mortgage rates are going to go? Any thoughts around that?
Well, I don't think they're going down. So you've got the Fed policy obligations or goals of managing the cost of money at the front end of the curve. With their decision about what to do with Fed funds or what they pay on excess reserves, and I think they're still indicating that they're going to be really patient there. But with these type of growth numbers, and I don't know how you can hide inflation for much longer, but it exists, and they're going to have to reckon with that. It's likely that that rates begin to move up at the front. At the long end, they control those rates by buying bonds, right? So that when rates begin to tick up, they or others come in and buy those rates back down. Eventually, they're going to have to start lightening up, either with their purchases or with what they actually hold.
Right.
An upward impact on rates. So, I don't know whether it's this year or next year, but it'll surprise me if we're in a sub 2% 10-year environment given the magnitude of the stimulus that's been injected into the economy, what we can see in terms of these hot GDP numbers, what's likely to be the eventual admission that we're living with more than 2% inflation, which they've talked about as being their target. And so, I assume rates are going to be higher. Now, with this, demand for home buying, I think that home buyers will pay more for mortgage loans, but the thing is going to run its course. I don't know what the in the moneyness of percentage of the outstanding stock of mortgage looks like at a 150 10-year,
right?
But it looks a lot different at 2% or 2.25% or wherever we ultimately go.
Right. Yeah, definitely. We're going to see. We're still busy. I mean, I think the biggest thing I hear about, you touched it in the Bay Area. I was in Utah, just inventory. So people are still paying up. Like you said, $1 million is a lot, but we'll see what direction of rates. I'm in your camp. I think definitely I'd be surprised too as well if it stays around this level towards the end of the year. So we'll see. Right. So John, last question for you. So. It's graduation season upon us. A lot of people are graduating from college right now that want to get into the either financial sector, the banking sector. You mentored so many people. You mentored me, and thank you for that. All the great feedback you've always given us. What's some good advice you can give younger people that want to get into the banking or the mortgage area or just the financial sector in general?
Yeah. So, I mean, I tell young people coming out of college or coming out of business school that my best advice is to put yourself in a job where you see a lot of flow, whether it's in the financial business, it could be deals, it could be loans, it could be M&A, it could be a range of things. But if you're going to commit a year, 2 years, 3 years, or some portion of time, be trying to master a trade or really learn a business. Get yourself in a position where you see, you just like a batter seeing pitches go by, you get better and better and better by seeing more of it. Yeah. And, that's true in other industries as well, but there's lots of spots in financial services where it applies. And then you end up with real perspective and some wisdom a few years out about whether it's for you or not for you. What side of transactions you want to work on, whether you rather be a borrower or a lender or an advisor or a principal, those types of things. And that's one of the things that makes our industry so fun for young people. That high transactions volumes, lots of customers, lots of deal flow, lots of information. Just it gives you experience at a relatively young age that's harder to get in some other industries. And so
awesome.
I take advantage of that.
Yeah, awesome. That's some great advice. One of the things that we are trying to do here at Kind Lending is keep on, trying to build a nursery, right? So in our industry, how do I build a nursery? How do we create more brokers? How do we create excitement around the mortgage industry? So that's some great advice, John. Thank you so much. And we took a lot of your time today, John. Hopefully you catch the Padres. I'm going to be catching the Padres. They're playing the Giants today up in the Bay Area. John Shrewsberry, thank you so much, John, for being our newest guest here of Del Talk. Your information was great. And it was great to see you, my friend, in person, man. I hadn't seen you in a while. So I'm digging the beard. Digging the beard. Keep it.
It's nice to see you. Thanks for asking.
Yeah, no problem. Thank you. All right, guys, if you want to learn more about John, you can visit him on LinkedIn. And if you want to learn more about Kind Lending, you can go to kindlending.com. You can follow us on our YouTube channel as well. Thank you for watching. Have a great day, everyone.
Bye-bye.
Bye-bye.